Hello, I'm David Hearn, founder and CEO of Sofer Advisors. Interest in opportunity zones is picking up again as investors revisit the tax incentives opportunity zone investments offer, deferral, reduction, and potential elimination of capital gains. But with that renewed activity has come a quiet problem. Many investors and QOF managers don't realize the IRS expects an independent, defensible valuation to support the numbers behind these projects. As more funds mature past the early development phase, the valuation requirement is showing up in audits, compliance reviews, and year-end filings, and for many, it's the first time they're hearing about it. What makes opportunity zone investments so attractive right now? Opportunity zones have come back into focus for a simple reason. The tax incentives opportunity zone investments offer are hard to ignore. Investors can defer capital gains, reduce the taxable portion over time, and, if they hold the investment for at least 10 years, potentially avoid tax on the appreciation altogether. That combination doesn't exist anywhere else in the current tax code. We're also seeing more institutional money flow into OZ projects than in earlier years. As funds mature and projects begin to stabilize, big players are taking a second look. And with that attention comes something else, more IRS scrutiny. The part that often gets missed is how tightly the opportunity zone rules are tied to fair market value. Whether it's measuring substantial improvement, verifying basis, or supporting a qualified opportunity fund's year-end reporting, fair market value sits underneath many of the compliance steps. When the numbers aren't supported, the tax benefits investors are counting on can be put at risk. What exactly triggers a valuation inside an opportunity zone structure? A lot of investors are surprised to learn that IRS opportunity zone valuation rules touch more parts of a deal than they expect. Opportunity zones aren't just about where the money goes, they're about how the value is measured at key points in the life cycle of the investment. Several common events automatically trigger the need for an independent valuation. Here are the situations that typically require one. The first situation is when property is contributed to a qualified opportunity fund. A valuation is needed to establish fair market value at the point of contribution, especially when non-cash assets are involved. The second situation is when a related party transaction occurs. The IRS takes a closer look at OZ deals involving related entities, making defensible valuation support essential. The third situation is when there are transfers, redemptions, or recapitalizations. Any change in ownership structure, units, or capital accounts generally requires updated fair market value documentation. The fourth situation is when funds hold private or illiquid business interests. Many QOFs invest in operating businesses rather than real estate. Those interests require annual valuations for compliance and reporting. The fifth situation is when a fund reaches a disposal or liquidity event. Exits, sales, or capital return events all require a fair market value determination to calculate the tax impact. Each of these triggers might seem routine on the surface, but without defensible valuation support, the compliance foundation behind the tax incentives starts to break down. Why isn't a regular real estate appraisal enough for OZ compliance? A lot of investors assume that if they have a standard opportunity zone appraisal, they're covered. But in many OZ structures, the property itself is only one part of the value picture and often not the part the IRS is most concerned about. A real estate appraisal tells you what the building is worth. OZ compliance often requires knowing what the business is worth. Most opportunity zone investments happen through a layered structure where a qualified opportunity fund invests in a partnership or operating company, which then owns or develops the property. Because of that structure, the IRS frequently requires valuations at multiple levels. Here's the distinction. A real estate appraisal values land, improvements, and comparable sales. A business valuation measures the operating company itself: revenue, cash flow, risk, and future earnings. A valuation of partnership interests determines the fair market value of what investors actually own: units, equity interests, or membership interests inside the QOZB or QOF. In other words, the property may drive the economics, but the investment sits inside a business entity, and the IRS wants to know the fair market value of that entity, not just the underlying real estate. That's why many OZ deals require more than a property appraisal. They require a valuation that matches the structure of the investment, documents investor ownership, and supports the tax incentives tied to the OZ program. What makes opportunity zone valuation more complex than a standard FMV? Most people hear fair market value and think of a single number, but an opportunity zone valuation rarely works that way. OZ investments aren't simple single asset holdings. They sit inside multi-layered structures with tax rules that expect a level of documentation most investors aren't prepared for. A typical OZ structure looks simple on paper: a QOF at the top, a QOZB underneath, and the project or operating company at the bottom. But each layer has its own economics, rights, preferences, and timing requirements. A valuation has to account for all of it. A few of the factors that make OZ valuations more complicated than standard FMV. First, there are layered ownership structures. A QOF invests in a QOZB, which may invest in an operating entity or real estate project. Each tier has different cash flows, obligations, and return profiles. You're not valuing a property, you're valuing an interest in a structure. Second, there are reasonable methodology expectations. The IRS expects a defensible methodology based on market data, income projections, and risk, not shortcuts, not tax allocations, and not a plug number designed to make the OZ math work. Third, there are mixed asset businesses. Many OZ deals combine real estate, operating income, and partnership allocations. That means the valuation has to capture both the underlying assets and the business generating value. Fourth, there are job creation and business plan assumptions. OZ compliance often depends on growth expectations, headcount increases, operating expansion, or development milestones. Those assumptions must be realistic, documented, and consistent with what the fund files with regulators. Fifth, there is alignment with regulatory filings. The valuation has to reinforce what appears in the fund's Form 8996, offering documents and investor materials. If those pieces don't tell a coherent story, compliance issues follow. OZ valuations aren't difficult because the math is unusual. They're difficult because the structure is. You're valuing the entire ecosystem around the investment, not just the asset inside it. Who needs a qualified opportunity fund valuation and when? And a qualified opportunity fund valuation isn't just for large institutional funds. It applies to anyone running or investing through a QF structure. The trigger isn't size, it's whether the fund or its underlying businesses hold assets that can't be valued without independent analysis. That includes real estate, operating companies, LP interests, and any non-cash contributions. Here's who typically needs a valuation and the timing that applies. QOF managers who must verify fair market value for annual filings, investor reporting, or audits. Investors contributing non-cash assets like property, equity interests, or partnership units, where FMV must be established at contribution. Multi-member LLCs inside OZ structures, especially when ownership percentages, buy-ins, or capital accounts depend on defensible valuation. And funds preparing audited financials, lender packages, or year-end statements that require third-party verification. Valuations inside OZ structures are either event-driven or annual. Event-driven triggers include contribution of property or non-cash interests, recapitalizations, redemptions, or reallocation of ownership, transfers between related parties, and liquidity events or partial dispositions. Annual triggers include year-end financial reporting, Form 89996 compliance, investor statements requiring current FMV, and audit cycles requiring independent support. If a fund holds anything other than cash or publicly traded securities, chances are a valuation is required, and waiting until filings are due is almost always too late. What role does a commercial opportunity zone appraiser play at exit? When an opportunity zone investment reaches the 10-year mark, valuation becomes just as important as it was at the initial contribution. A commercial opportunity zone appraiser helps establish fair market value at the moment investors claim the step-up in basis, the linchpin of the OZ tax benefit. If that number isn't defensible, the tax advantage can quickly fall apart under IRS review. Independent valuations also support investor distributions, especially when capital accounts or waterfall structures depend on accurate FMV refinancing or M&A events inside a QOF or QOZB, where buyers, lenders, or auditors require proof of value and audit and IRS documentation, ensuring the fund's narrative, financial statements, and tax positions align with the valuation record. These exit stage valuations often become the most scrutinized part of the entire opportunity zone lifecycle. That's why a valuation partner who understands QOF structures, regulatory expectations, and multi-layered assets becomes essential. SOFR Advisors steps in to ensure the final valuation is clean, defensible, and aligned with the rules, so the benefits investors planned on are the benefits they actually receive. How can investors protect themselves as opportunity zone rules tighten? As enforcement increases, one reality is becoming clear. Opportunity zone valuations aren't optional, they're required, and most OZ structures need more than one type of valuation to stay compliant. The risk for investors isn't just getting the math wrong, it's relying on the wrong type of valuation. A real estate appraisal when a business valuation is required, a partnership statement when the IRS expects fair market value, or an internal model when regulators want independent verification. This is exactly where SOFR Advisors reduces the uncertainty. We help investors and fund managers understand what needs to be valued, when it must be valued, and which methodologies are actually accepted under OZ rules. Our team delivers the independent, defensible valuations that protect tax incentives, support filings, and hold up under IRS review. If you're evaluating an opportunity zone investment or preparing for a filing, contribution, or exit, the right valuation partner can eliminate the guesswork. SOFR Advisors is here to guide you through the requirements and help ensure your OZ benefits stay intact.